Hi, I'm Norm Plumstead, the President and CEO of Honor Bank, and welcome to part 3 in my 10-part series on demystifying banking. And in today's video, I'm going to discuss the importance of bank capital and its crucial role in maintaining a healthy banking system. So let's start by first defining bank capital and what it is. So it is the financial cushion or buffer that all banks maintain to absorb losses and to meet the obligations of depositors and stakeholders. And it's comprised of 3 components. First is funds contributed by its shareholders. Second is retained earnings. And third is certain types of debt that banks can issue. So bankers and regulators monitor a bank's capital position quarterly through 4 ratios, and they are 1, the Tier 1 leverage ratio, 2, the common equity Tier 1 ratio, 3, the Tier 1 risk-based capital ratio, and 4, total risk-based capital ratio. So like all other things banking, bankers and regulators love ratios and metrics, and each of those 4 measures measure capital in subtly different ways, but they all have one thing in common, and that is that the ratio is computed by taking capital as the numerator and assets or bank assets as the denominator, and then it becomes quite a simple math function at that point. And as I said, banks report their capital ratios every quarter and must stay above certain minimum regulatory requirements. Now, you may have heard or read a bank describe itself as well capitalized. And that term may sound subjective, but it's not. In order for a bank to be considered well capitalized, it has to meet specific regulatory requirements. And they are that the Tier 1 leverage ratio needs to be over 5%. The common equity Tier 1 ratio needs to be greater than 6.5%. The Tier 1 risk-based capital ratio needs to be above 8%, and the total risk-based capital ratio must be in excess of 10%. You can find where a bank stands with all of these ratios via the UBPR, which I covered in my previous video. So if you didn't watch that, you can go over, watch that now, and find out A, how to get to the UBPR, and B, how to find those ratios once you're there. So why is bank capital so important? First, it acts as a protective shield. It absorbs losses that can arise from either loan defaults, market fluctuations, or other unexpected events. And this cushion allows institutions to continue operating during such period and ensures the stability of the overall financial system. Second, it serves to enhance depositor confidence. Because capital acts as a buffer, it provides a measure of assurance to depositors that an institution can continue to provide services even if losses occur. Third, capital restricts a bank from excessive asset growth. So how does it do this? Because banks have to meet minimum capital requirements, and remembering that a bank's capital ratio is defined with capital as the numerator and bank assets as the denominator, it means that in order to maintain a healthy ratio, asset growth needs to be funded by a commensurate amount of additional capital. And lastly, bank capital helps to protect the deposit insurance fund. It does this by placing owners, that is bank shareholders, at risk of loss should a bank fail, which helps minimize the potential for what's known as moral hazard, as well as promoting safe and sound banking practices. So thank you for watching. Remember that a strong capital base is crucial for banks to weather challenges, contributes to the overall stability of the financial system, and protects stakeholders. Feel free to reach out with your questions or comments by putting just a comment below, or give me a call or send me a text on my cell phone. The number is 231-709-1730. Thanks for watching, and I'll see you back here next time.